A very good afternoon to all of you, friends. I am Sanjeev Singhal, Chairman, Auditing and Assurance Standard Board and Sustainability Reporting Standard Board of the Institute of Chartered Accountant of India. I, along with my Vice Chairman, Vishalbhai Doshi in absentia, welcome you to the 74th program for this council year for the AASP. This year, friends, as you know, we have taken a mission to take the auditing standards learning to the doorstep of every member, because this is one area which is very, very vital. Audit quality is very important. And so far, we have covered all the auditing standards. We have covered CARO. We have covered the auditing related aspects in Schedule 3. And we have also covered element-wise items of financial statement, be it balance sheet, profit and loss account, cash flow statement, and the notes to the accounts. And now we are covering some more specialized topics. Friends, our expert panel on the various queries relating to auditing matters is already online. Please avail the maximum possible benefit of this. We have engaged more than 50 experts. So while auditing a corporate or a non-corporate sector, if you're facing any auditing related issues where you need guidance, please do write to us. Our response time is 24 to 48 hours, and this facility is free of cost for all the members of the Institute of Chartered Accountant of India. Friends, today's topic is internal financial control, and we all know the importance of internal financial control. Now, in the audit report also, there is a separate section whereby we have to report on the ICFR. This provision was introduced many years ago, but still members do face certain challenges and require guidance. That is why we have organized this webinar on the internal financial control. And now, of course, this is different from the internal audit because this forms part of the statutory auditor's responsibility. And I have the great pleasure of introducing the speaker for the day, CA Palak Shah, who is currently working as an associate director in a chartered accountant firm based out of Ahmedabad. He has total work experience of more than 13 years in statutory audit across various industries. Palak, thank you so much for joining us. And friends, it's indeed a pleasure to introduce my council colleague, Shri Priyaji, who is the chairperson of the Corporate Law Committee, a very, very important committee. An internal financial control requirement comes from the corporate laws. And she has done a pioneering work in the Ministry of Corporate Affairs. She is working on the LLP and providing a very, very able support to the Ministry of Corporate Affairs. She is also the convener of the Women Empowerment Directorate in the Institute. And during her first stint, I've seen her. At that time, I was a special invitee to the Institute. I was not a council member. I've seen her working so hard, and I really feel very good that she decided to join back the council after a cooling off period, after a voluntary cooling off period of one term. And she is now back in the institute and contributing very, very extensively and very prompt, very proactive. Thank you, Shri Priyaji, for taking out time. And I would also like to share with you, the Shri Priyaji, so far 87,000 plus members have joined these various physical as well as the virtual programs. And of course, we intend to do much more, whatever efforts we may do. But, whatever you do in the corporate law directly impacts the auditors. So these two committees actually work very closely with each other. And thank you for sparing time. And I would request for your keynote address. Thank you, and over to you.
To CA Sanjeev Singhal who's an exemplary member of the Central Council. And I think that term just about encapsulates everything. A lot to learn from him. And the way he carries out is the impeccable chairman that you come across. And to CA Palak Shah, who's the resource person for the day. I'm very, very honored, privileged, and delighted to be here today to present a very short keynote address on this seminar, which is on internal financial controls over financial reporting. And before that, I must place on record my appreciation for two things. One is the conduct of the program itself, and secondly, to actually track the metrics which I think Sanjeev sir has been doing exemplarily well. And to hear that, this is your 74th, I'd be delighted to participate in your 75th as well, because that's a milestone event. And to note that you've got 87,000 attendees is 1/3 of the institute, actually. So thank you very much, Sanjeevji, for this amazing work. And of course, we work together very closely on several initiatives that overlap between the CLCGC and the ASB. So as far as internal financial controls are concerned, so the context today, the entire landscape of financial reporting has undergone a significant transformation. So just present a few perspectives, numbered 1, 2, 3, 4, 5, etc. So perhaps you can recollect it when you're doing work. So the first thing is, I think there's been a huge transformation in terms of the revised Schedule 3. It's transformed the reporting landscape from mere financial reporting to what I believe is management reporting. Typically, when would you look at aging of capital work in progress? When would you, these are aspects, key financial ratios, etc. These were more in the context of a management report, and that's found its way to financial reporting. The second important thing I'd like to sort of present before you in terms of the landscape that's changing is, if you take purely the audit report that you present along with the additional disclosures, plus your CARO, plus the internal financial controls report that we provide, plus the Schedule 3, which anyway you're required to comment upon or consider in presenting your final opinion, I don't think there is a single critical question which is unanswered via the audit report and the financial statements on every single component of the financial statements, along with your 143.1 inquiries. So if you take your audit report, plus your 143.1, plus your ICFR, plus your CARO, plus the Schedule 3, the new disclosures, it's completely opened out the audit process to every single critical question on which you're going to comment. The next point that I'd like to make is fairly open. What is true and fair? True and fair essentially means two things. One is that your financial statements are in accordance with an applicable reporting framework, which is Schedule 3 in the case of companies. And the second is that your financial statements are free from material misstatements, whether due to fraud or error. But somewhere along the line, there's been significant thought that I see coming from the Ministry of Corporate Affairs in actually making this journey far more evolved. And today I can see that all their actions are getting them closer to more focused enforcement. For example, if you look at the latest rule that's come by, that's talking about registrars having to inspect companies which are getting created anew under Section 12. It says the registrar has the power to go do a physical verification. And if he finds that it's not going to be an operating company, so you find 600 companies getting incorporated in one location, today the registrar has the power to say, look, you're not a company, you're not into real business. So all the changes that I see in the corporate audit landscape are pointing towards tightening of enforcement in making people accountable. And the last part of what I'd like to speak on is about ICFR itself. Now, so in the accounting process, as I understand this very simplistically, you have an input, a process, and an output. Input is your transactions and vouchers and everything. Your transactions and events, more particularly. Your process is the actual process through which transactions go, the maker, the checker, the reviewer, the reporting. Again, the process comprises of various processes, which is your order to cash, your procure to pay, your hire to retire business cycles. And you had an output, which is your financial statements. Statutory audit was always in the past about output financial statements. Are they true and fair? Can I present an opinion? Can the auditor present an opinion? But after the advent of the Sarbanes-Oxley in the United States and the large corporate failures, there was a drastic shift. A shift from output-based reporting to actually process assurance, which is what ICFR attempts to do. And as Sanjeevji rightly mentioned, it was incorporating elements of internal audit. Like, for example, incorporating elements of management reporting into financial reporting. And finally, let's look at it this way. Whether it's an audit report or a CARO or an ICFR that we comment on, is it for the corporate? Not really. Is it for the auditor? Not really. I think all these statements and practices and frameworks have been created for the user. And it's in that context of a user that one has to do one's ICFR work and the ICFR report. And the last part that I'd like to speak about is my own conceptual, a very simplistic understanding of how ICFR needs to be delivered. And I'm sure Palak would do a much better job of it. But the way I envision ICFR is something very simplistic. Look at it like an onion, and it's like peeling many layers of an onion to get at the core of what you seek to provide assurance on. So what's the outermost layer of the onion? It's the company itself. It's the company that's an audit client or the company which you're assisting for preparation of ICFR. In fact, it's also a large professional opportunity. The second layer of the onion would be the various components of the financial statements. If you're looking liabilities to assets, it's share capital, reserves and surplus, secured loans, unsecured loans, current liabilities, provisions, property, plant and equipment, investment, inventories, revenues and receivables, cash in bank, whatever, as loans and advances as the components flow. Now, the way to approach ICFR, typically, the next level is your process. So you take, for example, fixed assets. You have processes in fixed assets. I'm just giving one illustration for the sake of brevity. But what would your typical processes on fixed assets be? It would be an overall reconciliation. It would be additions to fixed assets, deletions, depreciation, impairment, maintenance of a fixed asset register, physical verification, and now your CARO elements, such as title deeds being in the name of the company, aging of CWIP, which is now mandated to be reported, suspended projects, etc., etc. So the way one constructs an ICFR is to pull in the business process plus the unique reporting processes and make it into an amalgam. And so you have the company, you have a component, you have the processes that you seek to provide assurance on, and on each process, you examine what is the risk, what is the control, and is the company doing well in terms of understanding its risks and managing its risks through appropriate controls. So when you drill one down and go into the risk, what's a risk? Risk is any potential for a loss is a risk. Any uncertainty which can result in a loss is a risk. Suppose I send my child to the medical store. The entire journey, what could be the risks? An obsolete medicine, a small accident, a wrong pricing, a wrong medicine. So that's your risk library. And from there on, you build controls. So for fixed assets, I could forget to capitalize. That's a risk. So how do you protect that? Is to have a tracking and a construction or an installation certificate. So very simply, it's risks and controls that you document in one large matrix. A matrix that you build on a very common sense basis. Don't get into, there are of course frameworks like COSO, etc. But for small or mid-sized companies, which most of us would be handling, you build a very relevant, rational, and commonsensical framework. So what would be the components of that framework? What is my risk? My risk category could be a financial risk, an operational risk. What's a control? So for example, cash can get lost as a risk. What's a control? My cash is kept in safe custody. Is a control. Today you can examine whether your client has that control. And what kind of a control will it be? It could be a manual control or a system control. It could be a preventive control or a detective control. Then you assess that control for that risk and you provide a result. And if the sum total of all your results are hunky-dory and happy, you go back and tell in your report that internal controls are functioning effectively. So this is like, a very, very bird's eye view on how the ICFR process actually stacks up. Financial statement components, sub-processes, risk, type of risk, control, type of control. Some organizations might have standard operating procedures. So can I just put in that reference there to say, yes, it's an enshrined control. And then you do a test and you document the test. That's the most important. And then you pronounce the result. Of course, there could be a failure during the period, which has been rectified in the year end. Then it does not result in an adverse report on your ICFR. With these few words, once again, and please, the only thing is just to be very, very careful in the performance of our work. And if there's one auditing standard that I think we should really be very conscious about, it's documentation, because it showcases the work that you've done. And it's that one most important standard that can move you from, the deep sea of negligence to a safe haven of, having done your work justifiably. So please remember this, and here's it once again, wishing this program. And thank you very much.
Thank you so much, Shripiraji. The simplicity with which you explained the entire process of ICFR, how to do the testing, the risk involved, and emphasizing the documentation is really appreciable. And friends, there are 530 controls which are given in this guidance note issued by the ICAI, and it covers all the 11 processes. Do refer it to us. So thank you so much, Shripiraji. And Palak, may now request you to start your deliberation. Thank you.
Sanjeev, I have another meeting, but I promise I will listen to the video once Palak's session is done.
Yeah.
Kindly request your indulgence. Thank you.
Yeah, sure. Thank you very much. Thank you, Sanjay sir. Thank you, Supriya madam, for a very nice introduction on the ICFR concept. So today, dear all, we will learn on the basic IFC concepts. What are the practical situations which we come across during our audit? How we should deal with it? As Supriya madam rightly mentioned about the documentation aspect, we will go through that aspects also on a step-by-step basis. So our objective of this session is what are the understanding, or what are the regulatory requirements of the internal financial controls? What are the objectives? How it impacts the management and the auditors, and how, as an auditor, statutory auditor, we should approach the audit of the internal financial controls. So dear all, if we have any questions, we can take it up at the last. We can take 10 minutes, and then we can discuss all the questions which anyone has have. So yes, the Companies Act 2013. So the mentions under section 134, section 5, subsection 5, subsection E mentions internal financial controls means any policies and procedures that is adopted by the company for ensuring orderly and efficient conduct of its business, adherence to the policies and safeguarding its assets, accuracy and completeness of its accounting records, and timely and preparation of reliable financial information, and prevention and detection of frauds and errors. So the Companies Act mentions the internal financial controls in bifurcating in operational control, internal control over financial reporting, and fraud prevention. Today, we will try to discuss more on the internal control over the financial reporting, where our role as an auditor comes in. Yeah. So what is internal financial control over financial reporting? So as per a guidance note, which is issued by ICAI on the audit of the internal financial control over financial reporting, internal control over financial reporting means a process which is designed to provide a reasonable assurance regarding the reliability of the financial reporting and the preparation of the financial statement for external purpose in accordance with the generally accepted accounting principles. A company's internal financial control over financial reporting includes those policies and procedures that pertains to the maintaining of those records in a reasonable detail, and that accurately and fairly that reflect the transactions of the company, provide a reasonable assurance that the transactions are recorded as necessary to permit the preparation of the financial statement in accordance with the generally accepted accounting principles, and that the receipts and payment expenditure are being made only in accordance with the authorizations of the management and management and the directors of the company. That is about the segregation of duties. Third is to provide the reasonable assurance regarding the prevention and timely detection of any unauthorized acquisition or use of the company's assets that could have a material effect on the financial statement. So what are the basic requirements to which companies it's applicable? And what are the various responsibilities for the management, for the board, the independent directors under the audit committee itself, and the auditors? So yes, the basically the internal control reporting, internal financial controls are applicable to all listed companies and public limited companies, and private limited companies having certain threshold. The reporting under the same is applicable to these companies. So under section 134(5)(e), there is a director responsibility statement to state that directors had laid down the IFC, which is adequate for the design and operating effectiveness. Board report under Rule 8.5 also requires the board report to state the details in respect of the adequacy of the internal financial controls. Code of conduct, code of independent directors under section 149 also requires the independent directors to satisfy themselves on the integrity of the financial information and the financial controls and the system of risk management, that they are robust and defensible. Audit committee has the responsibility to ensure that adequate internal financial controls are there. They should discuss any, if there with the internal auditors and statutory auditors, in case there are any concerns with respect to internal financial controls. They should also discuss the key observations which they have come across, which have been reported by either by the internal auditors or the statutory auditors or by the management themselves during the testing of their internal financial controls. And the auditors report. And the auditor's responsibility comes to report on the adequacy of the internal financial control in the section 143, subsection 3, subsection and subclause 1 under the Companies Act. So basically, the requirement with respect to internal financial controls comes not only for the auditors but the management. So management has the primary responsibility establishing the internal financial controls over financial reporting, maintaining the same, and designing and testing the controls of internal financial controls over financial reporting. Then it comes with the responsibility with those charged with governance. In case of a private limited, it's the board of directors. In case of a listed and large company, is the audit committee. And then last, it comes to the auditors. So here I just tried to summarize the responsibility metrics here. Companies management, as we discussed, creating the IFC framework and documentation. The risk control matrix, will touch upon that also in the later slides. What is the risk control matrix and how it should be documented? Focus on the auditors, and that they should need to test the controls. They need to test the design of the controls, and then the report on the adequacy of the ICFR system being implemented by the management. The auditor's responsibility also to evaluate whether the system of the IFC being framed by the company or the management is adequate, whether there is a robust framework being aligned, which is in line with the applicable standards, acceptable standard, whether the IFC framework which has been implemented by the company is addressing the risk, which is for the objective of the organization being met by incorporating this IFC framework. Reviewing the auditor's comments, discuss the key issues. Board of directors' responsibility is to satisfy themselves on the strength of the control IFC framework, whether the IFC framework has been laid down adequately and effectively, whether the board will rely on the assessment by the audit committee also, and they may also ask for the additional information. This is how the overall responsibility with the ICFR reporting and the framework by all the stakeholders. So in this slide, we will try to cover what are the components of the internal control with the 17 internal control principle, which has been presented in the COSO 2013, along with our guidance, which has been given in our guidance note on the IFC. So there are 5 basic components of internal control. First is a control environment. Second is a risk assessment. Third is a control activities, information and communication, and monitoring. Each of the component is very significant importance for overall pyramid of the internal financial control over financial reporting. and for the also for the effectiveness of the internal controls. So when we say control environment, so what does it mean? So control environment means that the company has demonstrated, or the management has demonstrated the commitment to integrity and ethical values. Board of directors demonstrate the independence from the management, that is a management culture. Management with the board oversight establishes trust structure, that is organization structure, authority and responsibility. We can say SOD, segregation of duty within the organization demonstrate the commitment to competence, that the right skill has been engaged by the company to perform the nature of the task or the process, the transaction. Organization establish the accountability. The person, the company has put in adequate accountability framework. Second comes to the risk assessment. So specifies the relevant objectives with the sufficient clarity to enable the identification of the risk. So what are the objectives that company has put in for particular transaction, and what are the risk the company has or the process owner himself has identified? What are the risks and what are the significant change that can impact the system of internal control? The risk can change. The identification of the company, the management determines the risk at the initial stage. However, it changes over a period during the same financial year due to many reasons. Like there is a new pronouncement, like there is a change in the Schedule 3 requirement. So that risk, that will change the risk with respect to the financial reporting process. There is the risk. So, for example, the company has gone into a corporate restructuring. There is a change in the IT system within the organization that changes the risk with which the risk assessment activity has been carried out initially. Consider the potential for the fraud, whether the transactions or the process has the potential for the fraud in assessing a risk. So we should the company should assess whether there are any potential for the fraud. Then the control activities like process flowcharts, preparing the process narratives, risk control metrics, all should be, and performing the selecting the controls to test those risks which has been identified in the risk assessment. And then comes to the information and communication. Information, are there any information which is being produced by the entity and which being audited by us and taken used as an audit evidence in our audit? Are there any communication internally or externally with any of the third parties which requires our attention? And whether the overall internal control framework which has been incorporated or established, whether there is any change in that any framework, whether the framework is being working as intended by the management or by the company. Are there any control deficiencies which being observed in any of the are there any remediation plan being observed, are being implemented, whether those remediation has been implemented as planned? Are there any material weaknesses being observed, whether this material weakness has any impact on the audit report? Those assessment needs to be carried out on a timely basis, on a timely basis. So here we'll try to cover the what are the life cycle for the audit of the ICFR. So audit of the ICFR starts. So during any audit, what we as an auditor we need to first do is the identification of our significant accounts. What are the significant account and balances and disclosure which we want to audit? There are various 9 factors which our guidance round also helped us to consider while determining whether the account balance is a significant account balance or not. Then that comes to the what are the significant flow of the transactions or volume of the transactions. What are the risk of material misstatement that we'll call it RMM? What are the controls which address those RMMs? Does the process include any associated IT environment, any application controls are there? Whether then this comes at the planning stage. Then we will do the design testing, that assessing the design of the control, whether the control is working as designed, whether the control is implemented as per intended. Then we will see whether design and implementation is as intended or as the management is planned its objective. If yes, then we'll perform the operating effectiveness of those controls. Yes. So life cycle of the ICFR, like understanding the process, that covers the process walkthrough, then preparing the process flowcharts, then designing and implementation of the controls. Before that, we will do what are the risks, what are the controls, and then comes to the operating effectiveness of the control. And basis the operating effectiveness, we will try to come to the conclusion whether audit opinion can be issued, or unmodified opinion or a modified opinion. This is the conclusion on the operating effectiveness of the controls. This is how the road towards the audit of the internal financial controls looks like. As an auditor, what we will first do, we'll first prepare the process narratives, we'll process flowcharts, walkthroughs, what are the risk controls, risk and risk control matrix, key controls, and the relevant financial assertions. So during when we do the process understanding, for example, we do an understanding of the revenue process. So what we will understand the process, that all the understanding which we do, we need to document it. So when we document any process, what we should consider, the document which narrates the development of significant account by the process, it should include a major input sources, important data files, documents, significant processing procedure. What are the processing procedures being carried out to perform the transaction? What are the output files and what are the reports being generated from the processing of the transaction? What are the functional segregation of duties by the process owner, by the department, or by the process owner? Who are the individuals who perform the various steps in the process? What are the risks that has been identified? What are the controls that has been identified in and the manner in which this general account is posted? So that means how the accounting entry is posted to conclude to complete the transaction. So when we understand the process, we should consider how, what, where, why, when, where, and who. This all we should consider while understanding in any process. Then comes to the process map, that is a process flow charts. So there are different ways where the process flow can be described, either through a graphical, that is a flow chart, and the second is a process narrative. Process narrative approach verbally describes what happens, while the graphical approach includes the process flow charting in a very different way. So advantage of flow charting is it helps the understand the process very easily, represent the complex process in very simpler terms. You identify the risk, what are the controls very easily in the process flowchart. So yes, guidance also says that the process flow diagrams may be helpful form of documentation for the auditors to depict the process to initiate, authorize, process, record, report the transaction to a point within which the misstatement could occur, and the control activities that are designed to prevent or detect such misstatements, including providing greater transparency to the segregation of duties. So if the flowchart will help to depict the process, like how the transaction initiated, how the transaction is authorized, who has processed the transaction, how it is recorded, what are the reports or what are the output files being generated from processing of the transactions, what are the risks that has been identified by the management. So I just want to differentiate very clearly that our role comes to audit this risk control matrix of the process. So whatever the process the management has followed, we can club it this as a part of our process walkthroughs also. So when we perform a process walkthrough, we can collect those evidences which we understand while understanding the process. Yes. So how the process documentation is done? So we identified the process owner, discuss with the process owner the process and the sub process, document the process flow as explained by the process owner. So documentation is very key. Documenting the activities in the flow that take place, identify the controls within the process, and documenting the controls. Yes, after understanding and documenting and the process, as an auditor, we should always take the process confirmation from the process owner. Then, as an auditor, we also should identify what are the risks that the management is identified in the particular transaction or process. Against each risk, what are the controls that management has identified? For each control identified, and capture the details such as control, who are the control owners, what are the nature and frequency and classification, and discuss the discuss the risk control metrics and audit and control metrics with the process owner and obtain their process owner confirmation. So this is how the output looks like for the understanding the process. So yes, so what is a walkthrough? So walkthrough facilitates the understand the flow of transaction. As we discussed, when we understand the process, we understand the process and the flow of transaction. What are identifying the risk also? What are the controls that has been identified by the management? The engagement team should also perform the walkthrough at the time of documentation. So at least one walkthrough should be performed for a major class of transaction. So for example, in case of a revenue recognition process, so the auditor should understand and document the entire flow of transaction from initiating to the dispatch of sales. Like how the customer order has been, who has approved the customer order, how the sales invoice has been generated, how the price has been determined, who has approved the price, whether the goods has been dispatched from the factory or a warehouse, whether the goods if the goods have been dispatched from the factory, what are the delivery terms, then if the delivery terms, as for example as CIF, then whether the revenue has been recorded in accordance with the applicable accounting standard or not. And for all this, whether the adequate evidence has been documented or collected by the and have been ensured by the company while performing this. The process, so the entire process of initiating, authorizing, recording, processing, reporting each transaction control for significant process identified within the major class of transaction. The process is documented, should be validated by the process owner. That is very key. For example, if you go to any of your client and understand the process, but however you don't confirm it, then it may have a risk. Okay. Yes. So I'll just give you I'll just show that example, one sample walkthrough file. Just give me a second. So whenever you document any walkthrough, you should describe the process in detail, describe the accounting policies. If there are any IT application, as we discussed, a date on which when you perform the walkthrough, location where you perform the, if there is, for example, there are any multi-locations. For example, the company has a 10 manufacturing sites or 10 depots. So then you have to mention which location you perform the walkthrough, who are the attendees, who are the process owners and the attendees from the client side, and who are the auditees from the company's auditor side, and what is the description of the process, steps in the process, what is the activity sub process, what are the transactions stressed. You need to document method and nature of the walkthrough, evidence you have collected, nature of the application, what could be the risk, what are the description of that, what are the controls, the details of the controls, whether there is there any whether the transaction is associated with any significant risk. These are all things to be documented. Yes. Then what are the entity level controls? So entity level control is the internal control either at a group level or an entity level. Entity level controls operate at an entity level rather than an assertion level or a process level. And therefore they have any important but an indirect effect on the process level controls or a higher level controls. Entity level controls that could have a pervasive impact on the control activities over a significant accounts. Like for example, whether the company has put in an adequate HR policies, whether the board has adequate oversight. Those are the entity oversight over the governance structure of the company. These are all the entity level controls. So yes, within the COSO components and the intercontrol components, what are the major entity level controls like with respect to control environment, integrity, ethical values and actions of the key executives, program for involvement of board of directors and the audit committee and the board of the auditors in the administration and supervision of the prevention programs. What are the IT policies and management? So does the management fully respect this integrity and ethical values in regard to the management? Does the management specifically meet the level of capabilities, that is a competence? Then second comes the risk assessment. What are the entity level control risk assessment process? Identify new established and updated and other pertinent information for laws and regulations. Is there a sufficient structure to identify the risk caused by the external and internal factors? Control activities. What are the monitoring of the financial targets and operating results? Establishment of policies and procedure for accounting. Whether the company has prepared a budget for their financial year, whether the company has put in adequate policies and procedures for accounting, whether the company is following any accounting manual for preparation of the financial statement. So what are the check items? Are the organization systems being established for a midterm business plans or budget preparations? Information and communication. So information regarding the changes in the business environment and amendments to the accounting and related. So are there any controls at the entity level where the company has put in, wherein is in case in any for example, change in the GST, how it's going to impact the way the company functions. So whether there are adequate controls have been put in by the company that all these amendments or the regulatory changes have been upgraded or incorporated within the financial reporting system or ICFR framework. And monitoring. Then periodic assessment of the internal control, whether, for example, the risk control matrix which has been prepared by the management, whether it requires any changes considering the change in any circumstances. For example, any change due to IT system changes due to any restructuring. Does the management the company has put in adequate controls to see all these things? However, though the things will happen at the process level, however, whether at the entity level, are there any such control which have been put in to ensure that in case of any changes, this had been adequately upgraded or changed or done at the right time? That is what the entity level control is. Then in our process life cycle, that comes to the risk and control matrix. So what are the key things which as an auditor we should see when we audit the risk control matrix? The risk control, what is the major process? What is the sub process? What are the risks? What are the controls? What are the risk of material misstatement? What are the financial assertions? We'll come to that also. What are the control evidences? Who are the control owners? What is the frequency of the controls? What are the control methods? Who are the individuals who perform the various control process controls? And what is the testing approach? So when we say risk, so what is risk? anything that can jeopardize the achievement of the objective. So for any transaction, company has put in some objective, for example, revenue to dispatch of the goods. So how do we identify the risk? Then assess the business steps and ask what could go wrong. Either the goods are not dispatched as planned. Example of the risk, like in case of a P2P process, like GRN is not prepared at the time of receipt of those. For example, in goods are received, however, GRN is not prepared. Materials more than the PO quantity is inverted. Materials are inverted where the invoice rate is different from the purchase order rate. GST credit is inappropriately recorded, leading to liabilities at the later stage. So these are the risks, and then comes to the controls. How the controls have been put in place. This all things needs to be adequately documented by the company, and auditor has to ensure that all things are documented in a right manner. So documentation of controls in the risk control matrix should be considering what is the control, who performs the control, how often perform, when that is a frequency, where in the cycle flow does the control exist, and which reports are the source of information used for the activity. So when we come to the relevant financial assertions, then there are 6, like CWOP, that is a completeness, existence, accuracy, valuation, obligation, and presentation and disclosure. So like when we say a completeness, like this is the no unrecorded assets or liabilities or class of transactions or undisclosed items. When you say accuracy, like description, quantity, final value correctly recorded, processed, and reported. When we say existence, transaction exists at a given date and are recorded in the correct period of the financial statement. That is, when the transaction is recorded, they have adequate evidences are there before the recording the transactions. Then comes to the valuation, that assets and liabilities recorded at appropriate amount wherever necessary. Obligation comes, the assets and liabilities are underpinned by legitimate rights and obligation. And then comes to the presentation. The results of the operation are correctly presented in the accounts in compliance with the applicable GAAP. So in case of a order to cash process, how all the financial assertions can have an impact on the controls objective. Like E, ensure sales to existing customers. So system access to set up a new customer pair and sold to accounts, and to modify the records is limited to only authorized users in the credit department. This is the existence control. When we say C, ensure the completeness of the invoices, then the senior accountant who is familiar with the normal gross margin for each product or a customer reviews the gross profit for each invoice to identify any unusual transaction and ensure that all goods are shipped have been invoiced. V, ensure proper valuation. Like semi-annually, the vice president reviews and signs off on a worksheet for the reasonableness of the percentages used in the allowance for bad debts. Then O comes to the obligation. The vice president finance reviews the future lease obligations spreadsheet for all divisions, as well as a headquarter quarterly, and sign off on the summary, like non-cancelable operating lease with his name and date of the review performed. Ensure the correct classification of the account. Whenever the project team issues an invoice through SAP, this process automatically records the following entries into SAP FI, like debit to account receivable and credit to deferred revenue, and ensure the accuracy of sales, like for both sales order and direct shipment sales. Whenever the project administrator issues an invoice through a SAP, this process automatically records the sales and account receivable into the SAP. These are all the relevant financial assertions. Through when we identify any significant account, we have we also identify what are the relevant assertions associated with the significant account, and we try to perform our audit procedures surrounding those significant financial assertions. So when we document the controls, so what we should document and how we should document, that is very, very critical. So when we document the controls, we should check all the relevant documents which can prove that control exists and is effective. And in case of an IT related controls, we'll come to that also. What are the IT related controls and how it can impact our testing under the ICFR environment, and why IT system is relevant in our audit scenario. Okay, a screenshot of the automated controls. So when we document this, when we document the controls, we should document the screenshot of the controls. We should document the access rights, who have been given the rights, who has approved the emails, what are the policy documents, what are the price. For example, in case of revenue, what are the revenue, who has approved the price, whether the company has maintained a price master, whether the price master has adequate authorization, copies of the supporting documentation like GRN, approvals, SO. So this is on the right hand side. There is a one a small example. What the poor example of the end? What is the better example of the control evidence documentation? Like the control description is who performs the control and how it is performed. Like for example, allowance for a review of the doubtful debts. So then the poor the one example is how it is documented. The allowance for the doubtful accounts analysis reviewed monthly. That is one example, one way of doing the one way of documenting the control. And the better way of documenting the control is the allowance for the doubtful account reserve calculation is prepared by the credit manager, reviewed by the account receivable manager on a monthly basis. That is a frequency for this. Who has performed this, then the who have been involved in the system in this process is the credit manager and the account receivable manager. Who has performed is those two have performed it. What is the frequency and then been performed on a monthly basis. Then account receivable manager reviews the reviews the prepaid analysis for consistency with the stated policy of for 50% reserve for invoices outstanding more than 180 days and 100% for invoices outstanding. So this is the policy how it is been considered. The gross account receivable per analysis compared to the AR trial balance from the ERP application to determine the data in the analysis is complete and a screenshot is maintained to evidence that comparison. Additionally, AR manager reviews the support for all specifically reserved items greater than 10,000 and determines they are in accordance with the company's policies. Any required adjustments to be recorded in the general ledger for changes in the allowance are reviewed and approved prior to recording. This is how the adequate documentation should be done for the any control by an audit team. How the sampling? So this slide I'm trying to cover 2-3 aspects. One, when we perform any control testing, we should identify what are the manual controls and what are the automated controls. When we say an automated control is then control where the company is using any ERP and any control which is being performed by the ERP itself. For example, inventory valuation, depreciation calculation by the system itself. These are on the example of the automated controls. So when we plan to test the operating effectiveness of the controls, we should also see what are the frequency of those controls, and whether the degree of the risk associated that control has a potential impact on the misstatement on the financial statement. So that also there are various factors like when we select the samples for operating effectiveness of the controls, what is our risk of failure, whether it's a low or high, what is the frequency, whether it's an annual control, it's a quarterly control, or it's a monthly control, or a recurring or a daily control, basis which the samples can be selected for the performance, the operating effectiveness of the control. For example, here in one example, we have just covered so for in case the purchase order are authorized as per limits defined in the ERP based on the corporate guidelines. So scenario for testing, like what is the system configuration limit? So that can be configuration limit as per whether the system configurations have been made as per the corporate guidelines. Identify each scenario of the PO authorization as per the limits in the PO. Identify various type of PO like material or bulk procure PO, annual rate contract PO, revenue procurement PO, capital procurement PO. In case of services also, and if there is an annual rate contract or a one-time service. So this all needs to be considered while performing the operating effectiveness. This slide summarizes the how we should plan our testing. How we after testing we should see whether we have identified any deficiencies, and if there are any deficiencies, in whether we have whether the company has done any remediation, has planned any remediation to with respect to deficiency of the controls. So testing, when we say a testing of the operating effectiveness, then the conduct a testing as per the test. Auditor should conduct the testing as per the test plan and identify the gap. Determine whether the operating procedures are performed as documented and in a timely manner. Confirm the flow of information and transactions by inspection, observation, and inquiry. Confirm the understanding and the operation of control design, noting whether it agrees with the narrative or the flowchart. Review the design of the control. Maintain the evidence. Like the evidence to be maintained should be sufficient enough to assess the re-performance by the prudent official. So whenever we perform we document any work with respect to controls, it should be easily re-performed by any prudent official or by any third person who has no knowledge of the process. That should be ideal way of documenting the controls. Then the second comes to the identifying and assessing the gap. Deficiency evaluation process. Is the exception a deficiency? Evaluate if the objective of the test is achieved through root cause analysis, determination of the rate of deviation, qualitative factors. Is the weakness significant? Evaluate the possible impact on account balance. Measure the impact on the basis of materiality. Evaluate the existence of the compensating control. Are there any compensating controls with respect to any control which has been deficient? Whether that compensating control achieve the objective of the control which is failing. Cover the average potential risk. Reduce the impact to the error in order to make it non-significant. So we need to also ensure that whether the control which is getting deficient has any impact on our substantive procedures. Then monitor the remediation plan. Key objectives of the remediation plan is identify and implement an action plan that address the control deficiencies. Confirm the operation of remediated controls through retesting. So, for example, any control which has been remediated, then the control should be working effectively for a reasonable period of time within the financial year. So, as an auditor, we should test that we should retest those controls. Or in case the company has changed the way the control was designed earlier, then we need to also test the design of that remediated control. We should then test the operating effectiveness of those controls. When a control fails, they understand the root cause and then recommend the actions to remediate. And remediation is confirmed through retesting as discussed. Once the remediation is confirmed, the management may review the remediation and determine the new control effective date. Yes. So ITGC, why it's very important. So in this slide, we will discuss ITGC and how it is relevant. So when we perform any controls, then the company, because nowadays many companies use the ERP software. There are many processes and transactions are carried out by the IT system itself. So there are automated controls. So when we perform our testing of the internal controls over financial reporting with respect, for example, in the O2C process or in the P2P process, or for example in the inventory valuation. There are many automated controls which, as an auditor, we have to rely. And we need to test those automated controls. So if we want to rely on that automated controls, we need to test it. Before that comes to the testing the ITGC, that is a IT general controls. The ITGC controls are like the controls that apply to all system components, processes, and the data for a given organization or an information technology. For example, companies using the SAP. Then as an auditor, before we companies using an SAP and companies having a control like of an inventory valuation, wherein the inventory valuation is automatically performed by the system itself. So before we test the inventory valuation or before we rely on the inventory valuation automated control, we need to first test the design of the the system, that is an SAP itself. So objective of the ITGCs are to ensure that the proper development and implementation of the application, as well as the integrity of the programs, data files, and computer operations are being performed. So that is very, very relevant. That before we rely on the application controls, that is my inventory valuation control or my depreciation control, which is an automated, we should first test are proper development and implementation of the ITGCs. So what are the common ITGCs as an auditor we should audit? Like change management control. For example, there are changes in the there is change there are changes in the system. Some program change has been done. There are any logical access related controls. For example, there is any significant specific policies and procedures being followed by the IT team. What are the hardware and software and configuration? Whether the management has adequate disaster recovery plan or backup, whether the data center physical control, security controls are adequately put in, systems and data backup and recovery controls, and the computer operation controls. These are all broad controls, IT related, IT system related control, which an auditor should verify. When audit firm doesn't have the adequate IT expertise, they may also engage the IT experts to perform the audit. For example, in data this backup recovery and recovery procedure. In recently, I think MC has come up with the amendment that in case of a companies where the software is the servers are located outside India, they need to ensure that the daily backup are available. So this is the one, for example, one ITGC which we can also, as an auditor, we have to test whether the company has put in the adequate plan for the same. In this slide and subsequently one slide, we will try to discuss on the roll forward testing. So what is a roll forward testing or remaining period testing? Is testing that when we perform the testing of the operating effectiveness control at an interim date. For example, we perform an audit up to September, or perform a complete test at the interim date. And then as an auditor, we should determine what additional evidences concerning the operation of the controls for the remaining period is necessary to roll forward those conclusions to the balance sheet date, because we issue our audit opinion at the balance sheet date. So it is necessary that we roll forward those conclusions which we have performed at the interim date with respect to operating effectiveness of the controls to at the balance sheet date to support the opinion on the effectiveness of the internal financial controls and to support the reliance on the controls. The additional evidence that is necessary to update the result of the testing from the interim date to the company's year-end depends on the, like, what are the specific controls that have been tested prior to the balance sheet date, and what are the risks associated, whether the control relates to the significant risk or the control relates to the management overhead of control, the sufficiency of the evidence of the effectiveness obtained, whether the control, the auditor, as an auditor, we have obtained sufficient and appropriate evidence at the interim date. What is the length of the remaining period? For example, if the length of the remaining period, for example, is more than 3 months, then we may not able to rely on the earlier our conclusion at the interim period, and we have to perform the testing for the remaining period also. And possibility that there have been any significant change in the internal financial control. For example, in case of a company where there is a say revenue cutoff which is being performed at every quarter end. However, which has been performed on a manual basis, whereby company prepares an Excel file on every quarter end. They then determine the locations where the goods are dispatched, what is the normal lead time which they prepare on a manual basis, the Google map, and then they determine which revenue, which invoices needs to be reversed. However, this control was like being prepared by the sales and marketing team, and then being reviewed by the finance team. However, this control has been modified, for example, in the third quarter of the year, wherein the company has put in an automated control within the ERP, where the lead time has been determined for across the locations, and then they have determined basis the actual LRs which the goods have been dispatched, and put in the automated control in the system. So in this case, the roll forward test, we can't rely on the testing in the interim period. We have to perform a fresh testing on the design of the control and the operating effectiveness. Key activities which we should, as an auditor, we should plan for planning the roll forward procedures at the design and operating effectiveness. What are we should identify the controls being tested in the interim date. Then consider the management monitoring and ongoing monitoring process and activities to identify changes that give rise to the new risk. consider the evidence obtained by the management during the roll forward period, plan the nature, timing, and extent of roll forward procedure. These are all the auditor should plan while planning the roll forward procedures with respect to design and operating effectiveness of the controls. While which are the key activities should be performed for performing the procedures. Earlier one was the planning the roll forward procedure. Now the performing the roll forward procedures. To perform the procedures to determine any significant change, test the design and operating effectiveness of the modified controls, obtain the appropriate evidence of operating effectiveness to determine that control evidence interim did perform effectively, documenting the roll forward procedures, and log any deficiencies and further evaluation of their impact on the risk assessment. In the earlier slide, we have considered like performing the role where the company, where we have performed the testing of the operating effectiveness at the interim date. I've given one example here, like for example, in case of a company where we do the where the company has a process of doing the sending the confirmations to the daters at the interim period, and then rolling forward to the balance sheet date. So that company performs the complete testing as if, for example, company has taken the cutoff of 31st January, and then the 2 months roll forward is performed to reach to the balance at the 31st March. The auditor should also assess each of the factors that identified above for each relevant control tested as of the interim date to determine whether inquiry would be sufficient evidence of continuing the operating effectiveness or additional procedures beyond inquiry alone are necessary. So where the controls are routine in nature and the risk of failure is low, then inquiry and the length of the remaining period is not significant long, then auditor can also conclude that inquiry alone is a sufficient evidence for continuing the operating effectiveness, and no further roll forward procedures or additional procedures would be required to be performed further relying on the operating effectiveness of the controls. One of the important aspect is an IPE. There are many reports which the normally companies are nowadays using for their relying on the controls. So when we test the controls as an auditor, we also need to ensure that we do the audit of those reports, or the if we are trying to use them as an audit evidence. So that we call as an information produced by the entity. Like for information produced by the entity is typically the form of a report, which may be either a system generated or a manually prepared also, or a combination of both. As there may be a large amount of information that is generated by the entity for use in the managing the business and to analyze and prepare the financial information, auditor is only required to test the accuracy and completeness of the IP that is relevant to the audit and used as an audit evidence. That is very critical. When particular report can be considered, can be said as an IPE when we are trying to use as an audit evidence. And so all informations are not IPs. Okay. So understanding of the IP, 3 elements, like a source of the data, report logic, and the parameters. It is important for the auditors to understand these elements to determine the testing strategy of the IPE. So as an auditor, when we are trying to use any reports as an audit evidence, we need to test the data elements, that is an accuracy and completeness of that IP. So for example, here in case of a data's aging report, so what is the invoice date, what is a credit period, what is the customer code, customer, if the company is reviewing this report for a doubtful age, then we need to test these elements to rely on the report and to use as a control evidence. So IPs can be bifurcated in 3 buckets actually. IPs that when we perform at the relevant when performing the relevant controls, IP that auditor uses as an audit evidence when performing the test of operating effectiveness, and IP that we use at a time of substantive also. Like data's aging, which management is, for example, management is performing analysis of the doubtful debt on every quarterly basis. So that is an IP for the operating effectiveness and for performing the relevant controls for the ICFR. as the same aging for example, at the year end, which we use it for the purpose of relying on the accuracy of the numbers and the true and fair view of the on the data's provisioning. That is my substantive procedure. So that IP can be used as a audit evidence for the at the year end also. So IP has to be, the auditor needs to perform the testing of the IP during controls also and the substantive procedure also. One of the important aspects which we should, as an auditor, we should consider is the management review controls. So these are very important, there where there is a judgment involved, where there is an analysis, there is an exception reports are there, and on which there is and where the management performs certain expectations. Those are the controls where in the management review controls. And so as an auditor, we need to see whether the adequate precision has been put in by the management while performing those controls, whether so what is an MRC? So MRC can be in higher level controls or process level control also. Involves a member of the management or another employee reviewing the information contained in the underlying documents or reports to reach the or evaluate the conclusion impacting the entity's financial reporting. Information that may be reviewed include variance reports, exception reports. MRC can, as we discussed, the MRC can be higher level controls also or a process level controls also, involve the member of the management, which developing an expectation of what or she expects to observe in the information being reviewed, reviewing the information contained in the underlying documents, reports, or other IP. Information that may be reviewed include variance report, exception reports, comparing their expectation to the actual information to identify differences, investigating the differences, exercising the judgment to reach the conclusion impacting the entity's financial reporting. So if the control involves a control operator exercising some judgment to reach the conclusion, then control is considered to be an MRC. For example, review of the impairment working by the management, where there are many assumptions are involved and many judgments are laid out of the discount rate or the WAC or the forecast. So then we can consider, and there is an expectation as also there. Then we can say it's in a management review control. Similarly, a review of the budgets, where there is a comparison of the forecasted results and the revenue with the actual results, and the next and the comparisons are mentioned and discussed in quite detail by the management. We can consider as a management review control. So here in this slide, we'll try to discuss on the multi-location audit and the group audit. And then in the subsequent slide, we'll try to discuss on the homogeneity of the controls in the multi-location. So what is multi-location audits and why it is important within the ICFR framework? So multi-location audits and what is the basic difference between the multi-location audit and the group audit? So multi-location audit is like where the company, a single company has a 10 depots, for example, with respect to the dispatch of the goods, or the company has a 4 or 6 manufacturing plants. So whether as an auditor, we need to see whether all the 10 depots or 6 manufacturing facilities have a similar set of controls, whether the entity level controls are same across, whether the processes are being followed consistent across these locations. These are very important aspects, because when we perform the testing of the controls, either through a walkthrough or design or operating effectiveness, we need to ensure that the controls are operating effectively as designed across all these locations and not at a particular location. So yes, so what multi-location audits? So multi-location audits consist of multiple, as I said, multiple consist of the physical sites that are not components of the entity, where component is defined as an entity or a business activity for which group or a component management prepares the financial information. And second, it involves the one engagement team who performs the audit procedure at participating location, or a lead engagement team and participating auditors who perform the specified audit procedure on behalf of the lead engagement team. And so how it different from the group audit? So in case of a group audit, we have a 2 or more components, where a component is an entity or a business activity for which the group or component management prepares the financial information. So here normally in the multi-location audits, we observe there is only one single entity having different manufacturing facilities or a different warehouse, dispatching units. We call it a depot or a warehouse. However, in case of a group audits, we have a multiple companies or entities or components where this same business activity has been carried out. So I have given here one example of what is a multi-location audit and a group. What is an example of the group audit? Homogeneous control. So because we as an auditor wants to perform the control testing and want to rely on the controls, we need to, and we want to leverage that effort in our substantive procedure also. We need to we need to figure out, we need to assess whether the controls are homogeneous and how it impacts our overall audit strategy. If, for example, if the controls are not homogeneous, then how it can impact our audit strategy? Then we may have to, as an auditor, we have to then test the control around all the locations which are there in the multi-location. For example, as I said, if there are companies with 10 depots and the controls are not homogeneous, then we have to test all the aspects of the internal control which we discussed, like from the walkthrough to operating effectiveness for all the locations. But however, if the controls are homogeneous, then we may perform the process walkthrough of all the locations, and then we can conclude basis our understanding the process and the evidence is collected that the controls are homogeneous, and we can rely on this so that it can help in operating effectiveness of the controls over the entity rather than doing the testing at each location. Yes, but before we conclude on that, we need to assess whether the controls are homogeneous or not. So, for example, whether the business activities and the type of transactions are same in nature. For example, if the sale of products in the business is same, then yes, it's possible. However, there are different way of recognizing the revenue. For example, in a same company, there are 2 units where one is a manufacturing unit and another is a EPC. Then the homogeneity would be very difficult because the nature of transactions are different. And second, whether the transaction across locations are all using the same common IT system. For example, one location is using SAP and another is using, for example, Oracle as an IT system. Then the homogeneity will be very difficult to establish. Third, whether the operating policies, practices, and procedure are same across the locations. Whether the locations and business unit have the same processes, what could go wrong, and the control activities. Whether the location business unit is subject to same control environment, risk assessment process, and information and communication. So whether the components of internal control are similar across the locations. That means whether the location are subject to the same risk of material misstatement. Whether the locations or business units are subject to same level of entity level controls. For example, oversight of the board by the board or the audit committee is similar, is the same, and there is no separate board or oversight body for overviewing the the other business unit or a location. So based on evaluation of these factors, if we indicate that the locations or business unit where the controls are homogeneous, then we can leverage these audit procedure for internal control over all the locations. So in this particular slide, we will discuss on the deficiency evaluation. So first we understand the process. We prepare a narrative. We prepare a process walkthrough. We do before we walk through, we do a process flowchart, then process walkthrough, and then we see the process risk control matrix. Then we perform the controls. So this deficiency, we do before that we also do a testing of the design of the controls. So before, so where the deficiency can be observed by us as an auditor during the, So deficiencies can be observed during the testing of the design of the control, or testing the operating effectiveness of the controls. So auditor must evaluate. So yes, as an auditor, we must evaluate the severity of each control deficiency that comes to attention to determine whether the deficiency individually or in aggregate or in combination of other significant deficiency or material as at the balance sheet date. In planning and performing the audit, the auditor is not required to search for the deficiencies. Okay, but that are individually or in combination are less severe, or less severe than a significant deficiency. So how we should determine whether the deficiency is severe or not? So that depends on the control will fail to prevent or detect the misstatement of the account balances and disclosure, and what is the magnitude of those potential misstatements resulting from the deficiencies. So control deficiencies is defined, categorized either in broadly into the significant deficiency and the material weakness. So a significant deficiency is a deficiency or a combination of deficiencies in an internal control or financial reporting that is important enough to merit the attention of those charged with governance, since there is a reasonable possibility that the misstatement of the company's annual interim financial statement will not be annual or interim financial statement will not be prevented or detected on a timely basis. So deficiency in the exists either at the during the design or at the operating stage. So deficiency in the design exists when a control necessary to meet a control objective is missing, or existing control is not properly designed so that even if the control operates as designed, the control objective would not be met. Second, the deficiency in the operating effectiveness. It exists when a properly designed control does not operate as designed, or when the person performing the control does not possess the necessary authority or competence to perform the control effectively. So material weakness is a deficiency or a combination of the deficiencies in the internal control or financial reporting, such that there is a reasonable possibility that material misstatement will not be prevented or detected on a timely basis. So as we discussed on to determine the severity of the deficiency, we need to see the resulting in the misstatement in the account balances and the magnitude. So what are the factors that are relevant while evaluating whether the deficiency can be a significant deficiency or a material weakness? So these are the basically two factors that will result in a misstatement of account balance or a magnitude. So when we say the misstatement in the account balance, then we have to see the nature of the financial statement accounts and disclosures. What are the assertions involved? Whether the deficiency have any susceptibility to the asset to a fraud, the subjectivity involved, whether the deficiency involves any subjectivity, complexity, or extent of judgment required to determine the amount involved, whether the control which is deficient has any interaction with the other controls, whether the interaction of the deficiency, that means whether the control are interdependent on the other controls, possible future consequences of the deficiency, factors that affect the magnitude of the misstatement that might result from the deficiency or deficiency in the control include but are not limited to the financial statement amounts or total of transactions, and the volume of the activity in the account balance or class of transactions exposed to the deficiency that has occurred in the current period or that is expected to the future period. Yes. So as an auditor, we must communicate in writing the management and those charged with governance all material weaknesses and all significant deficiencies during the audit. When possible, a written communication should be made prior to issuance of the auditor's report on internal controls or financial reporting, to provide an opportunity for the company to remedy those material weakness or the significant deficiencies. If such remediation is performed before or prior to the balance sheet date, then auditor should retest those control before forming his or her opinion on the internal control over financial reporting. So yes, then we come to the where we have identified the control deficiencies, either significant or material weakness during the testing. However, management has remediated it before the year end. How it will impact. Then audit should express, because we express our audit opinion as at the balance sheet date. Accordingly, any control deficiency either relating to design or operating effectiveness, if remediated before, then auditor can issue an unmodified opinion. However, sufficient time should be allowed to evaluate and test the controls during that period. Management should allow sufficient time to operate that control to validate the operating effectiveness. Remediation should be happen before the balance sheet date. Yes. So before we conclude that the control deficiency has been remediated, it should operate within the reasonable period within the financial year before the balance sheet date to conclude that the deficiency has been remediated. So specified date for reporting on the adequacy of the, because section 143 does not specifically specify whether the auditor's reports state if the internal controls existed at the operating effectively during the period or under the reporting of the financial statement or at the balance sheet date. Reporting in internal control is like a commercial operation. While the testing is carried out on the transaction throughout the year, reporting is at the balance sheet date. For example, if the company's revenue recognition was erroneous throughout the year, but it was corrected, including for the matters relating to internal control, then auditor is not required to report. However, as an auditor, we may communicate the same as a deficiency to those charged with governance in accordance with our responsibility under SC 260. It should be noted that even when forming an opinion, internal audit should test the internal control during the financial year under the audit and not just the control at the balance sheet date, though the extent of testing or at or near the balance sheet may be higher. Accordingly, auditors should report if the company has adequate control system in place and whether they were operating effectively as at the balance sheet date. So our responsibility as an auditor to report on the internal financial controls lies at the balance sheet date. However, that doesn't mean that we'll test the controls at the year end only. We have to test the controls throughout the year to mention that the company has adequate internal control systems and they are operating effectively. Then it comes the auditor's response. This slide we are trying to cover the group audit scenario. Because section 129 of the company 129 subsection 4 of the Companies Act state that the provision of the act applicable to the preparation, adoption, and audit of the financial statement of the holding company also applies to the consolidated financial statement. In case of components included in the consolidated financial statements of the parent company, reporting on the adequacy and operating effectiveness of the controls over finance would also apply for the respective components if it is a company under the 2000, that is the company is incorporated in India. So the basic principle which under the consolidated accounts is that the reporting under the ICFR is applicable to not only the holding company but also to the subsidiary companies or joint ventures which are incorporated in India. So accordingly, in case of any component has so our audit opinion on consolidated IFC should also consider all the reportings made by the component auditors. So in case of a component auditor has modified an audit opinion on internal control over financial reporting or has communicated in deficiencies, significant control deficiencies to those charged with governance of the component, then as a group auditor, we should also consider the same while its communication and its impact on consolidated audit opinion in accordance with the severity of the control deficiency at the group level. We have just covered here one example. A component auditor has qualified an audit opinion with respect to internal control over financial reporting for a component which is 40% of total revenue and 50% of the profits of the overall consolidated accounts. Modification is with respect to inappropriate accounting principles being applied for revenue recognition. So whether the group auditor should consider the modifying audit opinion for the consolidated financial statement of internal control at the console level or at a console IFC. Yes, so we have covered all the slides. We can take up the questions.
Can you hear me, sir?
Yeah, I can hear you, sir.
Thank you so much, sir. It was wonderful deliberation. We have covered almost all the things relating to the subject matter. So I have received 2-3 questions. If you allow, can I ask the question, sir?
Yeah, sure.
So first question is, in case of a private limited company having all financial controls with the founder, whether it is sufficient compliance if we mention this fact in the audit report, and there is no delegation of authority as far as all finance activities are concerned.
So in case of a private limited companies where the controls are all with the founders, then they can be like, for example, in case of a delegation of audit, that can be done, because in case of a private limited companies, there is no audit committee. So yes, the primary responsibility lies with the board. So founder will be also one of the board members. So in case of a private limited companies, I would say the SOD, like the delegation of authority, should be approved by the board of directors. So then it is a sufficient compliance in respect to ICFR, I would say.
So one question is, what is the difference between the Indian ICFR versus SOX of the USA in terms of internal control, checks over financial reporting, and checklists in the SOX, any guide in the SOX?
So in India, the internal control over financial reporting has been largely taken from the SOX guidance only. So I would not say there is any difference, but we are trying to adopt as from the SOX only.
Okay, sir. Sir, SOX 2002 Section 404 Act is available on Google, but there is no other any official document for SOX testing, just like the guidance known on ICFR of the ICI. There is no policy document for SOX 2002 Section 404 testing, except for the bare SOX 2002 Act. So kindly suggest for this further.
I'll get back to you. I don't have any ready-made answer. I'll check. I'll get back to you.
One more same type of question. Any book on SOX 2022 or Section 404 testing of control in India, USA?
I have to check. I will check.
Any book or any study material?
I'll get back, sir.
Okay, sir. So one parent company having IFC in place, but outside Indian subsidiary don't have IFC processes, as not mandated under local law, where the company is operating. Right. Whether in consolidated financial audit report, do we need to qualify this?
No, because in India, our ICFR reporting on ICFR requirement is only with respect to the companies which are incorporated in India. So in case there are any subsidiaries which are overseas subsidiaries, then the requirement or reporting on the ICFR is not applicable only with respect to overseas subsidiaries.
Sir, one last question. Any other your expert opinion while the auditing to cover this internal financial control? If you give some tips.
So I'll just say that just stick to our guidance note. It has given a detailed guidance on how we should carry out our audit over internal control or financial reporting. So to summarize the from the guidance note, what we should do is we should always, before we test the internal control, we should understand the process in quite detail. We should perform the walkthrough. If possible, we should try to prepare the flowchart. If the company is already prepared, then it's well and good. Then we should map this process with the risk control matrix, which is being prepared by the company. And then we should test our operating effectiveness. This is a summary. So there is a detailed guidance which has been given in our. So I will suggest to stick to the requirements of the guidance note while performing the IFC testing.
Yes. So thank you so much, sir. On behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time and enlightening all various intricacies on internal financial control. Thank you so much, sir, on behalf of AASB. Thank you so much, sir. Thank you. Namaste.